Character trust is not easy to find or establish. Who do you like? Who do you trust? Who do you count on? Who do you rely on? How do you know? It's just that feeling that most of us have inside of us. Competency trust is easier to measure if you know what it is you're doing. At the Financial Enhancement Group, we use a proficiency exam for our financial advisors. We run them through the CFP program to become certified financial planners. We go through an educational process in the planning team every other week where everybody comes together. That's our process. What is your process to stay abreast? Give us a call at 800-928-4001 or go to yourlifeafterwork.com and get signed up for a Next Steps meeting. We look forward to seeing you soon. Well, good morning and welcome back to your Retirement Playbook. I'm your host, Joe Clark. So happy to have you along. Today, we're dealing with the three phases of finance in a deteriorating market. And we just got done addressing what we call character trust. Those are the people that we naturally like, we feel compelled to believe in, we want to believe in, and we tend to lift them up higher and higher as we believe in them more and more, just assuming that they will not falter at any stage. And then we have competency trust. Competency trust obviously being that part of the understanding of what's going on, of whether it's planning or whether it's medicine or whether it's cooking, whatever it is, keeping up to date and knowing the best possible solutions. What we know for sure, and what I've learned over the last 35 years of being in this industry, is that money works very, very differently at very, very different times. And you're at three different building blocks, and so some people prefer this picture, if you will, if you're watching us on YouTube. If not, you can always go to your Retirement Playbook and find us there. Some people prefer this. I prefer the airplane. I think money looks more like that. So we start in an accumulation phase, and inside of accumulation, what you're really trying to focus on is two things. Two things. Are you saving the right percentage of your money? It's not the amount here, ladies and gentlemen. It's the percentage. So if you're talking to your grandkids or your kids, or you happen to be a youngster listening to the show, it's the percentage that you're saving. Don't get caught up in what the amount is. And then secondly is, are you building tax diversification along the way? We're going to talk about what that is here in a second. Eventually, you will reach the form or the altitude of preservation. Preservation is the only time average return matters. We'll talk about that in the beginning or in the middle segment. But you've got to be there at the beginning and at the end of the period of time for an average return to matter. But that's the only time average return really does matter. Finally, you'll go into our forte, distribution. That's why it's called Your Life After Work. That's our website. Our focus at FEG for 25 years has been on the complexity of distribution. That's why we're so tax focused. You put it in, great job. How do you get it out? So Grant Thompson is one of our associate advisors of the Financial Enhancement Group. He's a youngster, just got married. And I asked him the questions, Grant, inside of accumulation, what would you ask somebody as they were preparing to begin to accumulate money? And these are four things that he gave us, and then I'll address a little bit about them more. He said, one, does your employer have plans such as a 401k, and are you at least putting it in up to the match? So 401k obviously is a company-sponsored plan. You can't do it on your own unless you have your own business. Then you can. But a 401k is for the profit sector, 403b are for teachers and for nurses, and you have the ability to put them in. Typically, there is a match inside of the 401k if you are contributing. Now, some plans actually put money in for you, whether you're contributing or not. But most of them require you to put in a match. It's very typical to see something like 50 cents on the dollar up to 3 or 6% of your income. So if you're making $50,000 a year and you're saving 6% a year, that's $3,000, right? Then the employer is going to match 50 cents on that. That's another $1,500 that they're going to put in the plan for you. That is great. And as Grant so aptly put it in this, are you at least putting in up to the match? That is free money. All free money is good money. Now remember, inside of that company plan, you may have two options. One may be a Roth option. One is a tax-deferred option. All money that your employer has to put in has to be tax deferred. So if they're putting in a match, or if they're whatever they're contributing, has to be tax deferred. You, on the other hand, if they have an option, gives you the choice of picking whether or not you want to have that money be taxable today, right? So you're paying the taxes on it today, but then you don't have to pay the taxes on it in the future, or whether you want to defer the taxes and get a deduction today and then have to pay the taxes later on. And I will tell you, people that I've dealt with for many, many years still get confused over this. They'll walk in, just happened with one of my closest friends a couple months ago. He said, Joe, I don't understand. We're never going to make more money than we make right now. They're both my age, 55 and 50. But we're never going to make more money than we make right now. Why in the world would we be putting money inside of the Roth option? We believe that the tax rate is going to go down, or our income, rather, is going to go down. And I looked at him and said, ladies and gentlemen, friends of the court, you're exactly right. Your income is going to decline. But because you accumulated so well, because the performance of the portfolio has done well over an extended period of time, the market has done well. Because of that, the amount of money that you're going to distribute, whether you spend it or not, is immaterial. The amount of money that you're going to take out of the plan is going to cause you to be in a tax rate, in our opinion, equal to or greater than where you currently are. That's why you're using the Roth option. Remember, when you use that Roth option, it's simply giving you choices. You're making a choice today to be taxed today, but you're also making a choice in the future about when you want to pull the money out. What the tax implication is in the future doesn't matter to you because it's tax-free. You've already paid the taxes that are on it. Right? So that gets us to Grant's question number 3. Are you properly diversifying your tax situation during accumulation? Remember, I told you had 2 goals during accumulation. One was saving the right percentage of your income. The second one was that tax diversification. So ideally, when you go to retire, or when you go to what I call separate from the workforce, because we just don't find most people retired, ideally, in a perfect world, we have 1/3, 1/3, and I realize if you're watching this on YouTube that the drawing's not perfectly equal. I apologize. But at 1/3, 1/3, 1/3, 1/3 of the money is tax deferred. That's money that your employer put in, money that you put in when you didn't have a Roth plan as an option, or you used a tax deferred IRA. 1/3 of it is tax free. That's your Roth option, whether that be in your 401k, 403b, or whether you build it in a Roth IRA. And 1/3 is after tax. Now, why do I do this? Because I want to have choices. Ladies and gentlemen, regardless of how much you prepare for today, there are going to be surprises, good and bad, that hit you along the way through your financial journey. It's just part of the deal. They will come. You want to be the best prepared to deal with surprises, good or bad, as you possibly can. And the best way to do that is tax diversification. If one of you knows for sure what the IRS is going to do, please let me know. Just send me an email and say, hey, Joe, I have an inside track. I know for sure this is what's going to happen. I have people tell me all the time, there's no way the rates aren't going to go up. There's no way that the rates can't go down. You know, we have this mixed belief. And it doesn't even matter what my opinion is. What I want to do is make sure that you are prepared to be able to deal with the consequence of the IRS making decisions in the future that dramatically impact your retirement. See, we spend so much time focusing on what's our average rate of return while failing to look at what's going on in terms of the tax diversification. And I will tell you, if you're young and you're in the accumulation mode, and that's the best way to think about that is when what you're contributing this year is a large percentage of what you've already accumulated, you are very much still in the accumulation phase. When what I'm putting in this year is a sizable percentage of what I already have, you are very much in the accumulation phase. And your focus is not worried about the return. Your focus is make sure that you're building this tax diversification. And understand, as you're younger, while you're younger, you have the option to use the Roth IRA or the Roth 401k, whereas when you're older, you may not qualify. If your income level is higher, you may not qualify to use a Roth IRA. And so don't worry about this one third now. That's the end of the journey. That's the objective when you separate from the workforce. But now get as much of that money as you can in the tax-free side. And this is the one that I see people miss. It's this side over here. Some people used to call it an emergency fund. Well, emergency funds are critical. They're important to have. It doesn't mean they have to be left in cash. It just means it has to be money that's accessible. And remember, in a Roth IRA, your contribution is always accessible. There is no 10% penalty. The contribution, not any conversions and not any growth, but the contribution is always accessible. So you can use that for the emergency fund money if you have to. Start with that tax-free side, get it as loaded as possible, save the right percentage of your income. Don't worry about the amount as much. And then the fourth question that Grant put down is, while the market down, are you continuing to buy? And the answer is, I sure hope so. If you go Google it or you look anywhere, you're going to see programs that are about dollar cost averaging, D-average they call it. And the concept of dollar cost averaging is markets tend to work like this over a period of time. There will be down periods and there will be up periods. And in accumulation, if you're buying along the way, right, even though that this may be a high point relative to right now, it's a low point later on. And so you're able to take all of the prices that you paid, maybe 10, 9, 8, 7, 6, maybe 11, maybe 12. You're able to add all those shares together that you bought, and then you come up with a price that is lower than what the current price is. That's how dollar cost averaging is supposed to work. But the key thing is, do not worry about the return today. What you want is the return to be in the later phases of life. Where you really want to focus right now is saving the right percentage of your income and making sure that you're building that tax diversification along the way. It may sound like a long way away when you're 20, 25, even 30 or 35 and you're trying to raise kids. Joe, I'm 25, 30 years away from being able to separate from the workforce. I just want the best tax break I can get today. Who knows what the future holds? Well, 35 years of history tells me what the future holds, and it's not pretty if you don't plan today. Save well and diversify your taxes, ladies and gentlemen.